if you pushed me, I would say what we discussed earlier is that we are probably ready for a little bit of an inflationary burst going forward as energy prices tighten and the impacts of higher interest rates find their way out there.
What are the latest energy dynamics that investors need to be paying attention to? The CPI report revealed a slight tick up in energy prices and gasoline, and we'll be talking about that. What does China's deflation mean for commodities demand overall? And what does the Fitch downgrade mean for not just the financial markets, but perhaps commodities, resources, and the overall macro outlook? Thank you for coming back, Doomberg.
David, great to be here. You are looking as dapper as ever, and looking forward to a great discussion.
I appreciate it. Thank you. It's my uniform now, if you want to call it that.
It's on brand for you. I love it.
Doomberg, you are the head author of the Doomberg substack, which I encourage everyone to check out. I'll put a link in the description below for those of you who don't know Doomberg. The collective writes about energy, geopolitics, and everything in between. So I want to talk about energy first. That is your focus of your research. In the latest BLS inflation report, you can see a slight tick up in gasoline energy prices overall. It may or may not have contributed to the slightly higher CPI print from a month ago. So prior month in July, we had 3.0%. Now it's 3.2% headline CPI. First of all, am I correct to assume that higher energy prices or a slight uptick was responsible for the slightly higher CPI print?
Well, I mean, whenever you have a measurement that has puts and takes like that, you can isolate one, but for sure energy was higher and the CPI surprised ever so slightly to the upside. I do think when you look at the markets today, there are two hotspots to keep an eye on, or at least for investors to keep an eye on for cues as to where the CPI number might be going in the future and how the Fed might react to it. One is actually a crack spread. So the price of oil versus the price of the refined products is always an interesting thing to observe. And right now we're seeing, if you look at the Bloomberg 3-to-1 crack spread index, it's as high as it's been since last year's crisis. And one of the parameters that is most highly correlated to inflation is, in fact, the price of diesel, because diesel is used to truck all of the goods and services around that we produce in the economy virtually. And so when diesel is spiking, inflationary pressures rise. That's one spot in the market we would keep an eye on. The other is natural gas, in particular, the international market for liquefied natural gas. We're starting to see perhaps a bit of peak complacency a few weeks ago, as now sort of people are rubbing their eyes and seeing that another winter's coming. Last winter was pretty mild. There's a possibility of a strike in Australia that could significantly impact supplies. And just this week, obviously from pretty depressed levels compared to the crisis, natural gas in Europe is up some 40%. Natural gas in the U.S. is spiking a little bit. And so we would keep an eye on those two things, the international price of natural gas, which of course can then bring up the price of coal and other energy inputs as arbitrage globally plays out. But most urgently for inflation, we would keep a close eye on the diesel, jet fuel, the crack spreads that the refiners are harvesting right now in the market.
Can you just break down in layman terms why those spreads are widening?
Well, oil is a pretty complex product, and in fact, it creates what we call byproduct economics downstream. And so when you refine a barrel of oil, you have to do something with all the components. And so while the market for gasoline, say, might be fully supplied, the market for diesel or jet fuel might be in shortage, or you might have excess supply, and those prices tend to interact with each other in weird ways. One of the primary drivers is the fact that the U.S. has not built a new large-scale refinery in over 40 years, and so we have pretty tight refining capacity margins. The warm weather does impact yields in some instances. How refiners operate overseas is not within our control, but certainly affects the global market, and so on. And so it's not yet at the same highs that we saw last year, but if you erase last year, it's as high as it's ever been in the years before that. And so it's just something to keep an eye on, especially given the absolutely critical role diesel plays in so many of our supply chains.
So would you attribute this rise, or perhaps any future rises over the next 2 months, to a seasonal change, or is this a structural change in the demand supply fundamentals here?
So I know we're going to talk about China, but and data out of China is always a bit of a black box. But as their economy reopens, even if it's perhaps at not the same pace that people were anticipating, it is still increasing demand for these refined products. Some of the sanctions makes it a little bit more challenging for Russian oil to find its way to some of these refiners overseas, but it still manages to. There's all manner of reasons why it's kind of hard to predict, but if you're just looking for a leading indicator of future inflation and how energy might impact it, I think the strongest is just simply pull up the price of diesel on your Bloomberg terminal.
Well, okay. Roughly what percentage of the CPI index would diesel cover?
Well, there's direct and then indirect. And so it's pretty hard to measure all of the indirect. But if you just think about any physical good that is, imported, exported, moved around, invariably either via locomotive or truck, diesel is going to be an input into the cost of those goods. And so as diesel spikes, those costs at first eat into the margins of people, but then over time, those prices get passed on to consumers. And so that's why we keep a close eye on diesel.
Assuming all else is equal, meaning no significant other changes in the rest of the CPI index, could you make the statement or the assessment that by the end of the year, CPI could be on par with current levels, if not higher, meaning we've kind of reached the bottom for the headline CPI?
That's a great question. Obviously, it goes well beyond diesel. There is a lot of debate, I would say, in the FinTwit community about whether higher interest rates are in fact inflationary. As we're paying out over $1 billion in interest here soon, which is just incredible. $1 trillion in interest payments alone. Those are kind of, as our friend Luke Roman calls it, the fiscal stimmies for rich people. It's still expenditures, fiscal expenditures finding their way to the economy. Of course, the velocity of that money is not quite as high as it would be if you were just giving stimulus checks to the entire population. But $1 trillion a year in interest on the way to 1.5, I would guess, by the time we're done, is truly remarkable and begs the question as to whether or not we truly are at the beginning of a fiscal cliff.
Well, actually, on the topic of diesel, suppose diesel prices were to go up, not maybe dramatically, maybe by the order of a few percentage points or maybe even double digits, but what would that directly or immediately translate to higher goods prices? Meaning, what is the lag effect usually between higher diesel and then suppliers or wholesalers having to ramp up their prices to compensate?
So there's the price you see on the screen, which is a benchmark that then many participants in the economy use, right, to negotiate prices. And so there certainly would be a lag. And as I said earlier, some people would have to eat it in their margins before they could reset their price if they have a fixed contract that they have to get through. But by and large, all things being equal, of the commodities that matter, diesel is a particularly important one as you measure inflation. And one of the reasons why inflation backed off from the highs, of course, is that the energy crisis abated, and included among the abatements that we saw in the market were, in fact, that the price of diesel and refined products did come down from the spike of last year. This is why, of course, President Biden was releasing 1 million barrels a day of oil from the Strategic Petroleum Reserve, and I think that move was almost single-handedly responsible for the price of oil coming down from 130 to 70 to 75. It's inching back up now. We're at a very interesting phase here, with WTI in the mid-80s, which is kind of the sweet spot for everybody involved. If it gets a little too high, then I don't think people get comfortable. But we're right on that edge. Like I said, the refiner crack spreads are, if you take out the spike from last year, they're as high as they've ever been.
This conversation reminds me of an interesting question that was asked to Jerome Powell at the last FOMC meeting last month. A reporter asked him, because energy prices over the last year have been coming down by themselves, how much credit would you attribute the lower inflation we've seen over the last 6-7 months to the Fed funds rate rather than just energy, perhaps, or anything else?
Yeah, and that they didn't come down by themselves, of course. I mean, they were managed down overtly by the Biden administration for largely political purposes, which I don't think is a partisan statement. They were heading into an election, and they didn't want the price of oil where it was. And Biden is extremely sensitive to the price of gasoline at the pump. And so the release of that 1 million barrels a day played a huge role. I would argue that the release from the Strategic Petroleum Reserve is largely responsible for the relative slowdown in inflation. We're still in an inflationary environment, but I do think that energy is such a critical component to many supply chains that, yeah, I think, and coupled with the fact that we had an extraordinarily warm winter in Europe, which led to the collapse in the price of natural gas, which led to collapse in the price of coal, which allowed a bit of breathing room for many countries around the world, thankfully. And let's hope that happens again this winter.
Yeah, which begs the question how this is going to impact monetary policy. Suppose weather conditions or other supply and demand conditions warrant a higher energy price towards the end of the year. How do you think Jerome Powell will respond?
That's a great question, and one of the reasons why people think elevated interest rates might in fact be inflationary, aside from the fact that we've never run this experiment, i.e. raising rates at this rate with so much debt on the books, is because it increases the cost of capital for oil drillers and producers, especially in the shale patch, which would then discourage new supply from coming online, which would then tighten up the physical market and lead to elevated energy prices. And so high interest rates, at least as measured in your desire to keep energy prices under control, can be counterproductive in that scenario.
We're assuming, of course, there's no dramatic credit collapse event that may dramatically shrink liquidity. That may play a deflationary force, right?
No question, right? 100%.
Before we move on, do we see any evidence of that potentially happening? Any cracks in the financial system you've noticed since last we spoke, I think 2 months ago?
Other than the headlines coming out of China, and the bit of perturbations out of Japan, of course, and then the German deindustrialization continues apace. But as far as like burgeoning crisis, I think that the Feds did a nice job of putting a cap on the regional banking crisis that was beginning to erupt here in the U.S., and some confidence has been restored. I would keep a close eye on the commercial real estate market, of course, at these interest rates with a wave of refinancing coming. And so there's always, we just did a Doom Zoom Pro for our Pro tier, and it was called Doom Scrolling, searching the globe for things to worry about. And we found them. If you go looking for them, you could find things to be worried about. I would keep a close eye on the weather in Europe. One of the things we said in that presentation was, yes, it was unseasonably warm last year, but in March we finished a 3-year La Nina cycle, and now we're into an El Nino cycle. And if you look historically, during periods of El Ninos, Western Europe tends to have very cold and dry winters, and let's hope that doesn't happen. But if it does, you could see things heat up pretty quickly.
So let's talk about China in more detail now. It's a good segue. So China's economy slipped into deflation. Consumer prices declined in July for the first time in more than 2 years. Now, it's interesting to note that while the rest of the developed countries have seen a boom in consumer spending after the pandemic restrictions ended, China's economy did not. I wonder if that's solely a function of their lockdowns having extended longer, or perhaps there was another reason as to why Chinese consumers probably did not spend to the same degree as other countries in the West.
It's a great question, and I always start any answer about China with the data you're quoting is what the CCP has put out. Nobody knows what's actually going on the ground. If the data is to be believed, to tie back to your question earlier about deflation, there's, at least from the outsider perspective, and again, any Western analyst claiming to know what's going on inside of China, you should treat with a bit of a skeptical eye. But if their property market has collapsed to the extent that at least the bond market is telling us that it has, then you could imagine that they are finally absorbing sort of the global financial crisis, housing correction over there. God knows they've been building residential, condo buildings, ghost cities for years and years, and everyone has always assumed that someday there would have to be a reckoning, whether that is today. And the CCP has worked to preemptively pop that bubble in a controlled way, and whether or not they're able to successfully do that remains to be seen. But why are they telling the world that they're in a deflationary episode right now is the question that I would try to ponder. Anytime I read anything about China, I ask myself, why am I reading this now? To quote Ben Hunt, because that's actually, the managed information and data coming out of China. And it should be said that recently China has really cracked down on foreign consultants and data trackers working inside the country. And so our already opaque view into this critically important economy got a lot dimmer. And so I'm sure you're familiar, right? They raided a few consulting firms' offices and have really sort of shut down a lot of the work that was going on that informed outside Western investors as to the state of the Chinese economy. And they've really increased their grip on the official data and who gets to see it. So I would wonder why we're seeing that now, as opposed to whether it's actually going on.
That is a fair question that's been brought up in many actually financial news articles, that perhaps this deflationary episode has lasted longer than has been reported, which begs the next question, whether or not you think China has already entered a recession. Notwithstanding questionable data aside, we have to consider the fact that the country has probably been in some sort of economic decline for quite some time. Is that possible?
On the one hand, it's certainly possible. All economies must go through a recession eventually. That seems like the natural order of things. On the other hand, we just set a worldwide record for oil demand in June, July, and at 103 million barrels a day, I think I saw this morning. That's pretty robust demand for critical inputs into the front end of the economy. One wonders whether there isn't a bit of management of the energy prices on the part of China by putting out these relatively bearish headlines. They too are obviously very keenly interested in the price of oil, given how much of it that they are forced to import. I would also say that the price for Russian oil has surpassed the cap that the G7 has tried to impose upon it, which is another indicator of relatively robust demand for oil. And so and the U.S. economy, of course, is a little stronger than people perhaps had anticipated, certainly than we anticipated. And so whether or not they're in a recession or not, through their official pronouncements, the data we're seeing back to diesel and jet fuel and so on indicates that the economy globally is probably doing okay.
Don't you think that this deflationary episode in China could perhaps curb the rise of prices, consumer prices, that is, elsewhere? Could it have a ripple effect on the West?
Sure. It depends on the depth of it. And don't forget, a lot of as big and as important as China is, a lot of reshoring and friendshoring and movement of major manufacturing facilities, that trend continues. And so places like Vietnam and Indonesia and so on, Southeast Asia, are becoming more important over time. But I don't see it. Well, it's not my lived experience, of course, but I'm not in China. My friends in China don't seem too worked up about it. But if you pushed me, I would say what we discussed earlier is that we are probably ready for a little bit of an inflationary burst going forward as energy prices tighten and the impacts of higher interest rates find their way out there.
Well, suffice to say, China has seen some sort of slowdown. What does this slowdown mean for commodities, base metals in particular, assuming that there isn't a brisk recovery immediately?
Well, it would certainly be bearish, unless, of course, you believe the green energy transition story, in which case there would be a headwind to an otherwise relatively strong tailwind. I would say that we again are, when you just look at the Bloomberg Commodity Index, the amount of runway ahead for commodities relative to equity prices, for example, still seems like we have a pretty substantial road ahead. And if we're going to do anywhere near the green energy transition that has been funded effectively by the Inflation Reduction Act, then we're going to be running short of some base metals here pretty quickly.
Okay. Well, I'm looking at the copper price, for example, that has been falling all year. So I'm guessing the effects of the Inflation Reduction Act haven't really taken effect yet.
So this is a great question. So if you look at the projections, there's not enough copper, nickel, cobalt, lithium, and yet many of them are trading relatively weakly, which then tells us that perhaps the market doesn't believe that this transition is going to materialize in the way that many people are modeling it. And in fact, if you have a shortage of any one product where you need all products for something to happen, then that necessarily means the other products won't see the demand spike. So if there's not enough lithium, for example, to execute the green energy transition, then we won't need as much copper as people have been perhaps projecting. On top of that, if the China property market is really slowing down, then that would dwarf any or swamp any potential impact, at least in the near term, of the green energy transition, because the amount of copper piping and all the other stuff, the wiring that goes into new home and new condo construction is pretty substantial. And if we're seeing that slow down, then that would explain it as well.
Or maybe the markets have already priced in a reasonable growth or transition towards green energy. I'm not talking about perhaps the government's projections or demands for a transition. Let's say no gasoline vehicles by 2030 or whatever the case may be, depending on the jurisdiction. But I'm looking at lithium, for example. The price has fallen this year, but still up relative to 5 years ago. In fact, it actually crashed in the last 2 years. Interesting market dynamic. Yeah, what do you think base metals and strategic metals are projecting in terms of this transition?
It's fascinating, especially lithium is kind of hard because it's dominated by China again, right? And so when you look at that price, you always sort of have a little starting. So if you look at the 5-year chart of copper, it's a pretty interesting one. As you say, it's been down, but if you go back to the just before COVID, it looks like we're up about 35 to 40% over that sort of range that it was in before it collapsed with COVID, and then it climbed because of the fiscal stimulus associated with the economic recovery. And so as I see 8,300 on my screen today, that's still relatively expensive from a historical perspective, and so, but it's not pricing in decades of chronic shortages that you would anticipate if we're going to follow through with those mandates to remove internal combustion engine vehicles from the road.
Okay. So for traders watching, perhaps they're wondering whether or not any significant changes will happen. We talked about energy. We talked about base metals. Any significant changes will likely happen by the end of the year. No one can predict changes. Let me rephrase that question. Any particular events they should be watching for that could perhaps signal changes?
I would keep an eye on the BRICS summit. Of course, everybody is deeply interested in what's going to come out of that summit here in the next few weeks and what it means for the price of gold. We would sort of fade the excitement around that, but you never know. They may surprise. I would keep a very close eye on the weather, especially in U.S. Northeast and Western Europe, which looks slated to have a colder than average winter. We would know pretty soon, I think, in sort of like that October, November timeframe, as things cool down or heat up, depending on which way the whims of Gaia decide to impose upon us. And of course China, like what's going on with China, what's going on with the U.S., China, Taiwan trade situation, potential for kinetic conflict. That's another thing, obviously, to keep a very close eye on.
Just on the BRICS summit, very quickly now, there's been some speculation, murmurings that one of the topics of discussion at their upcoming summit may perhaps be a joint basket currency that could be based on commodities, some sort of gold backing. What that was even speculated. I'm not seeing any of this reflected in the price of these commodities. So I'm curious to get your thoughts here.
Yeah, we wrote a piece on this called Something or Nothing, where we took a bit of a deep dive into see whether this would actually manifest. Gold is sitting at $19.20 an ounce right now as we record this. And, that's pretty high historically, again, like the other commodities we discussed earlier. I think that that the gold bugs, the people who are huge gold fans, were hoping that the BRICS group of countries would announce a joint currency where international trade imbalances were at least partially, cured up with gold as the reserve asset, and in so doing, perhaps reprice gold in U.S. dollars at least substantially higher. If that were actually likely, I think you would have seen it in the market. The market's pretty good at sniffing this kind of stuff out. And so I think, India backed out of it, and people have sort of walked back to expectations of anything meaningful coming from the summit. But if you ask me for things that might be a surprise or that we're intellectually curious in observing, that would certainly be in the near term something to keep an eye on.
Okay. Yeah, that it should be interesting to see how any sort of price change after the summit. That could be a better signal. Finally, the Fitch downgrade of U.S. credit last week. Any significant impact, first of all, on interest rates? Do you see short-term rates going up because of this?
Actually, we keep a closer eye on the long end of rates, but I would say the Fitch downgrade, that Fitch decided to downgrade the U.S. I don't think is all that relevant in and of itself, except for it expresses concern for what's actually going on with the U.S. fiscal situation, which I think is legitimate to be concerned about. We passed $1 trillion in debt in the Carter administration, and the first $1 trillion budget happened during the Reagan administration, and now we have $1 trillion worth of interest payments going out the door every year. And if you just do the math on 32 billion or 32 trillion in debt at 5% interest, obviously there's some duration and these bonds have to roll over, but that's 1.8 trillion a year just in interest payments theoretically. If we keep these rates this high long enough that we have to refinance all of that debt, I think the average length of the U.S. debt is something like 6 years, a very short period of time, and so and a lot of it comes due before that, and so the long bond is healthily above 4% again, which is something to keep a pretty close eye on in our view. But I don't think the Fitch downgrade itself matters. I don't think there's going to be any forced selling as a consequence of how Fitch appraises the creditworthiness of the U.S. But I do think that the fiscal situation of the U.S. is something worth keeping a close eye on. Lord knows we have nobody left in Congress who even pretends to care about having any discipline or any talk of a balanced budget. And so we're not going to get one. And ultimately, we're going to have to issue an awful lot of debt here to roll over the debt that's retiring and to cover the interest payments on the debt that we are now issuing at these elevated rates.
Do you think this downgrade may have some sort of impact on Jerome Powell's decisions going forward? Perhaps he may be, I'm just speculating here, there's no evidence of this, but perhaps he may come under pressure later on from members of Congress to lower rates sooner rather than later?
I don't think the Fitch downgrade is going to be that much of an input into what Jerome Powell does or doesn't do. And I do think the Fed is always susceptible to significant outside political pressure. And that has only grown once the Fed has meddled ever further into the economy. Post Greenspan's put, each new chair of the Federal Reserve has been called upon to do more and more to keep a lid on various crises as they arise. And Jerome Powell will be no different. But the market has bestowed upon the Fed unbelievable narrative power at a minimum. Everybody sort of trades on each utterance of that position. And I wouldn't want that job. I mean, we talk about limited upside and only downside politically, that would be, among the worst jobs out there in my view. So yeah, Jerome Powell will come under political pressure, already has been, but I don't think that the Fitch downgrade per se is all that meaningful to him.
Yeah, I wonder if he has some sort of stress management system. It is a stressful job when you think about it. Like,
I wouldn't want it. Yeah,
he always seems so calm on camera when you see him at these press conferences, and very rarely does he lose his temper that I've seen. I don't. So yeah, good temperament is probably a probably a prerequisite to the job. Just like Xi Jinping. Have you ever watched clips of Xi Jinping at public appearances? He doesn't have any facial expressions. I'm not sure if that's something that has been required of him by the Politburo, or that's just his character. I don't know.
That's it. I wouldn't want to play him in poker. Yeah.
Yeah. What are you working on these days in terms of research? What can we look forward to on your Substack, perhaps next week?
Yeah, we just published a piece on cancer recently, which is a new area for us. It was pretty interesting for us to dive into. Right now, we're working on, again, the natural gas situation, especially in Europe, heading into the winter. Like, where are we? Let's assess that. And we're also actually thinking about updating a few of the pieces that we've put out. There was this room temperature superconductor alleged breakthrough that we wrote about. And it looks like perhaps our view that you should fade the excitement around that announcement looks like it's going to be correct. There is a big push in the U.S. to mandate that natural gas and coal-fired electricity plants do a far better job of sequestering their carbon. And there's a lot of uproar within the industry in that front. And so lots of things for us to write about for sure over at the Doomberg Substack.
Yeah, excellent. I encourage everyone to check it out. And just on that note, 2 days ago, you published a piece called Warehouse Wars, spotlighting a conflict that's about to go full kinetic. That's a very powerful, punchy title. Can you just summarize that for us very quickly? And we can read this in more detail. Yeah.
Sure. Connected to the diesel situation, of course, the Port of Los Angeles and the Inland Empire has seen an explosion in the number of warehouses that are needed to service the Port of Los Angeles. And as we've gone to the digital e-commerce economy, one-click buy, a big chunk of those products that show up within a day on Amazon Prime end up passing through this network of warehouses. And the environmentalists in California, working with local politicians, have decided to do everything they can to obstruct and roll back and even make existing structures far more difficult to operate and to put people out of business. And this is another inflationary pulse that is a little under the radar that we decided to highlight. And it's a pretty interesting article, interesting for us to research. And ultimately, we think it'll backfire. You'll just cause these trucks to drive further, and you'll increase emissions and so on. But the attack on warehouses is something that we wanted to put on our readers' radar because we think it's real and could be pretty impactful.
Okay. Wow. All right. I never expected a kinetic war to start from petty disputes with Amazon and co. But okay. Well, let's hopefully let's see that's not play out. But I appreciate you covering it nonetheless. Visit Doomberg Substack. I'll put the link in the description down below so everyone can check that out. Thank you very much, Doomberg, for spending time with us today. I appreciate it.
Same here. Anytime.
Thank you for watching. Don't forget to subscribe.